Another move from Trump, the United States has announced its intention to create its own sovereign wealth fund. This will essentially be a large investment account designed to accumulate and grow public funds globally. Sovereign wealth funds, some of the world's most influential financial institutions, are based in countries such as Norway, France, China, and the oil-rich Gulf states. These funds hold hundreds of billions, if not trillions, of dollars, investing in everything from companies to real estate to sports teams around the world. The primary function of these funds is to provide a stable, sustainable source of revenue, supporting national economies and long-term planning. So, the idea of the U.S. creating one seems reasonable on the surface, especially considering that the U.S. is now the world's largest oil producer. If there's ever been a time to start saving, it's now. Yet, the general consensus from economists and financial commentators has been skeptical, with some dismissing it as a bit impractical. But is that fair? While it's true that many sovereign wealth funds have been built by countries with large natural resource revenues, the U.S. does indeed have the resources to create such a fund, especially with its booming oil production. Even a modest sovereign wealth fund, scaled to the size of the U.S. economy, could still be a formidable player in global financial markets. Of course, this comes with its own set of advantages and challenges that need careful consideration. So, how could a U.S. sovereign wealth fund work? And what issues might it face or create? The first challenge is managing investments effectively. It's not just about choosing what to buy. Keeping track of everything is a complex task. Enter Snowball Analytics, a portfolio tracker designed to make investment management simpler and smarter. Unlike typical trackers that only show share prices, Snowball factors in dividends, transactions, and even upcoming payouts, so you always know where you stand. For dividend investors, the event calendar is especially handy, laying out when payments are expected. Snowball connects to over 150 brokers globally, ensuring your data is always up to date, no matter your platform. And if you're comparing performance, Snowball includes a backtest tool to measure your portfolio against benchmarks like the S&P 500, including dividends. Check out Snowball Analytics for a more streamlined approach to managing your investments. Historically, sovereign wealth funds emerged as a way to save for future generations during times of economic instability. Think grain silos or gold reserves. In the last 50 years, the concept has evolved, with countries leveraging global trade, finance, and new wealth creation to build modern funds. The first large-scale sovereign wealth funds were created by countries like Kuwait, which used its oil wealth to establish reserves for the future. Today, almost 100 countries have such funds, representing up to 10% of global GDP. Norway's sovereign wealth fund is often cited as the gold standard. The country takes its oil revenues and turns them into diversified financial assets, effectively creating a buffer against the day-to-day volatility of the oil market. This prevents issues like the Dutch disease, where an influx of oil wealth harms other sectors of the economy. However, not all sovereign wealth funds are managed with the same foresight. Some are opaque, and leaders in certain countries treat them more like personal piggy banks than tools for national prosperity. In contrast, countries like Australia have set up funds not from resource revenues, but from privatizing public assets, a model that works but is often debated. The U.S. sovereign wealth fund, if it were to materialize, would face challenges, most notably a lack of immediate wealth to draw upon. While the U.S. produces a significant amount of oil, its revenue from this industry is taxed far less effectively than countries like Norway. For example, tax incentives like the intangible drilling cost deduction could cost the U.S. government $13 billion over the next decade. In addition, the U.S. allows oil companies to deduct foreign royalties in ways that could cost another $12.7 billion. But the issue is more than just missing tax revenue. Unlike countries like Saudi Arabia, where the government owns natural resources, in the U.S., landowners control the rights to oil and gas. This means the government has to incentivize drilling, which isn't the most profitable arrangement for public coffers. So could the U.S. still establish a sovereign wealth fund? Technically, yes. The U.S. government could allocate money into a fund every year, even if it's running a deficit. However, this would be a huge challenge, especially considering the U.S. already spends more than it earns. A sovereign wealth fund would be better suited for countries that are running surpluses, not deficits. And with current budget cuts and tax reforms threatening to reduce government revenue by trillions over the next decade, now might not be the best time to start an ambitious investment fund. But there's another factor to consider. The U.S. has the benefit of excellent credit. The country can borrow money at very low rates, allowing it to make investments with borrowed funds. While this could work, it's also a risky proposition. If the stock market were to crash, the U.S. would still have to repay its debts, which could destabilize the currency and undermine public finances. Moreover, the scale of the U.S. economy complicates matters. Even if the U.S. set aside hundreds of billions for a sovereign wealth fund, it would need to be managed carefully. Investing that much capital all at once could disrupt global markets, driving up asset prices and making it difficult to secure good value. On the flip side, a sovereign wealth fund could help the U.S. diversify its holdings and protect against economic instability. But it also raises concerns about the U.S. government owning large portions of public companies, which could create conflicts over corporate governance and decision-making. Norway avoids this by deliberately excluding its own market from the fund, but the U.S. faces a more complex issue, given the size of its domestic markets. As for the motivations behind creating a U.S. sovereign wealth fund, there are several reasons. One is geopolitical positioning. Countries like China have their own funds, so why shouldn't the U.S.? Additionally, a sovereign wealth fund can serve as a tool for national prestige, showing off the country's economic prowess through high-profile investments. There's also a domestic angle. Such a fund could help boost the current administration's political agenda by investing in projects that align with its goals. Finally, a sovereign wealth fund could help insulate investments from the political changes that inevitably come with elections. Despite all these reasons, there's still a real question about whether the U.S. should move forward with this plan. A sovereign wealth fund could be a useful tool, but in the current economic climate, it may not be the right tool for the job. If the U.S. does move ahead with the fund, it may end up being a modest initiative, possibly boosting certain industries while raising concerns about market manipulation and the government's role in private business. At the end of the day, the U.S. may be better off focusing on more targeted economic strategies rather than rolling out an enormous fund that could have far-reaching implications. A sovereign wealth fund is a valuable tool, but in the U.S.'s current economic situation, it may not be the best fit. Thanks for watching. For more videos about Digi Finance news, subscribe our channel.